Hello everyone, and welcome to today's Dynamics 365 Tech Talk. Today's topic is subscription billing, deferrals, and allocations. My name is Tim, and I will be your moderator today. We are broadcasting this session through Teams live events, and the audio can be heard through your device speakers. This session is being recorded on behalf of the Microsoft Corporation. When you join this event, your name, email address, and/or phone number may be viewable by other session participants in the attendee list. By joining, you are agreeing to this experience. The recording will be available on the Tech Talks Community Dynamics page within the coming weeks. If you have questions for our presenters or need support, please use the Q&A panel located on the right side of your screen. Our presenters will be responding to your questions throughout the session and in a live segment after the presentation. Thank you for your patience during these announcements. Presenting for us today from Microsoft, we have Brian King, Principal Product Manager Lead, Jodi Christiansen, Senior Product Manager, and Adeel Edhi, Senior R&D Solution Architect. Brian, over to you.
Thanks, Tim. Welcome, everyone. Good morning, good afternoon, depending on where you're at. As Tim mentioned, today we'll be covering subscription billing, and we're going to be talking about revenue and expense deferrals. So we'll dive right in here. So a little bit about the agenda for today. We're going to talk about an introduction to revenue and expense deferrals. We're going to cover some fundamental concepts. We're going to do some product demonstrations, and then we'll finish up with Q&A. As Tim mentioned, you can ask questions throughout the presentation. We'll try to get to them as we can when we're taking breaks from presenting and toggling back and forth. So we'll dive right in here. So today we're going to cover some different features in subscription billing. So just a little bit of an overview there. We're going to talk a little bit about billing schedules. We're going to talk about invoicing. We're going to talk a lot about deferred revenue. We're going to talk about accruing unbilled revenue. So we're going to have a couple demonstrations around that. We'll also talk about revenue reallocation. So those are some of the topics that we'll be covering today. Just a quick kind of prerequisite. The subscription billing module itself is 3 modules. So those modules are recurring contract billing, revenue and expense deferrals, and multiple element revenue allocation. These are all controlled in feature management. So they shipped in 10.0.25. So if you're on 10.0.25 or later, you can turn these features on. So starting with the parent key of subscription billing, and then you can turn each of the individual modules on as you need. One caveat with that is the revenue recognition feature that's part of General Ledger has to be off for any of the subscription billing features to be on, and vice versa. So you can only really run subscription billing or revenue recognition, one or the other. With that, we'll jump into an introduction to revenue and expense deferrals. So we'll take a look at some of the setup pieces that are going to come into play in the demonstrations that we'll do today. So a little bit of an overview. The revenue and expense deferrals can be straight line or event-based. They can also be percentage of completion. They can follow our billing, or they can be created from a template. So these are all based on settings, and we can talk a little bit about those settings here in a moment. We can make credit adjustments and apply those to our deferral schedules. It's compliant with IFRS 15 and ASC 606, and we'll take a look at that particular example at the end. And we'll also talk about multiple element revenue allocation and what that means. Secondly, where can deferrals be created? So we can create these deferrals. They can be created from a general journal, accounts payable invoice journal, the vendor invoice. So in this case, you'll notice that there's an asterisk on this one and the next one for free text invoice. For those 2 scenarios, you have to do the deferral from the accounting distributions. So in a vendor invoice scenario, you have to be in the invoice step and then go to the distributions, and then you'll see the deferrals button. You can do these from the sales order, and then of course from the billing schedule itself. So we'll talk about some fundamental concepts and how those come into play here. So we have what are called deferral templates. So these are part of the setup of revenue and expense deferrals. In this case, what these are our templates that can tell us how we want to defer particular scenarios. So in this case, you'll see the example that's highlighted is that it's going to be recognized over 12 months. So what this means is we have a period frequency of monthly. We'll see that we have a type of recognized, and that period length is 12. So that's a number of periods. If that period length was 6, it would be 6 monthly installments of recognition. The next setup that we have is deferral defaults. So these are the default accounts that would come into play based on your setup. So here you'll see there's tabs across the top for sales order, purchasing, general journal, free text invoice, and invoice journal. So those will correspond to the documents that we talked about a couple of slides ago. And then you'll have your posting types along the left-hand side. So here you'll see like deferred revenue, deferred discount, deferred consumption, and the setups for each of those. The next setup is if we want an item to be deferred by default. This is an optional setup. It doesn't have to be set up for you to defer anything. But if you do set this up, when you use that item in a scenario, it can have that deferral automatically created for you. So you don't have to go and click the box for deferrals and then specify a template or anything like that. You can have all that set up for you and ready to go. And then we can defer charges. So if you do that, then you can set up the charge. So you can set it up table, group, or all, depending on the charges. So in this case, we're doing it for a specific charge. This is for freight. So it's set to table. And then we have event-based deferral templates. These templates will be a little bit different than our straight line templates that we looked at earlier. In this case, you can have events or milestones that will determine when that revenue gets recognized. So in this example here, we're doing it based on a percentage, and then we're allocating a percentage on that event. In this case, it happens to be one event, so 100% will get recognized on that event. The second one shown here, 3 events, that has it split by different percentages for each of the 3 events. You can also add these events as you go along, so you don't have to necessarily have anything in the lines here. You can add those lines as you get to a recognition state or an event. Our last setup is our revenue and expense deferral parameters. So in here we can tell things like, do we want our allocation to be equal amounts per period? How do we want to handle discounts? Do we want to separate those from our original schedule, or do we want those combined in there? When we have prior periods, do we want to combine those prior periods together? What should the deferral start date be? In this case, we have it set to transaction date for our examples. Short-term deferral method, this can be rolling periods, it can be none, it can also be fiscal year. Then we also have the options for balance sheet and profit and loss. So you might see examples of those throughout the demonstrations. And then we also can, when we create the recognition journal, we have the option here to automatically post that general journal. So you can either create the journal and have it stop there, or you can create it and have it automatically posted. We can also have our recognition journal summarized. So this can come into play if you want to lessen the number of entries that go to GL from that particular recognition process. Then we have our journal name that's going to create our journals. So with that, we'll jump into some product demonstrations. So we're going to go through roughly 6 demonstrations today of different features and functionalities in revenue expense deferrals and also multiple element revenue allocation. Our first example is going to be a straight line deferral of revenue for a service item. So in this case, what you would typically have in a non-deferred scenario would be at the time of posting of the invoice, you'd have a debit to your accounts receivable and a credit to your sales. In our example that we're going to go through, we're going to add a deferral in there. So what happens then at invoice time is that you'll see that we'll swap out, and instead of posting to the sales account or that revenue account, we're going to post to a deferred revenue account. And then as we go through and recognize revenue, so in this case, indicated by the second entry you see at the bottom of the form here, is 12/31/22, we'll reverse or recognize $20.83 of that revenue, and then that will go to the sales account. So you have that intermediate step added in there. So with that, we'll jump over to the product and take a look at this particular scenario in action.
For our first scenario today, we're going to take a look at a service item, which will be a straight line deferral using the balance sheet method. We're going to start with a sales order. So I'll go ahead and create our sales order here. So our sales order will be for a customer, and we'll create that sales order here. So customer, all wholesales, and we'll go ahead and add a line. Now on the sales order, what's going to happen is I'm going to bill the sales order on December 1st. And we'll see here, based on the setup that I have, our unit price for our item is going to be $250. And we're going to defer this over 12 months. So we'll take a look at the deferral here. And we'll see that this defaulted to deferred. And this is based on the setup that we had. And then we'll also see some information as far as the accounts that are going to be used. So we'll see our deferred revenue account here will show up in the revenue deferral account number. And then we'll also see where we'll recognize that revenue to, which is the 401-100. So these accounts will come from the inventory posting setup of that particular item. In our case, as we mentioned, we're doing a straight line deferral. And then we also mentioned that we're doing this over a period of 12 months. We can consolidate prior periods, so this comes from a parameter setting. In our case, we don't have any prior periods, so it's not going to make a difference in this particular scenario. And we had this template default in based on our setup. We could also just do a non-template and then specify an end date, or override the start date and specify the start and end date. So based on our template here, we're going to end up with a deferral that'll start on 12/1 and then it'll run until 11/30 of 23. If we would want to, we could go to the preview button here. We can preview what that deferral is going to look like, and then we can see the amounts for each period listed in here. I'll click OK, so we'll save our deferral information on there, and then we're ready to invoice our order. So I'm going to go ahead and invoice, and then given that this is a service item, we can skip ahead and not have to do a pick or a pack here. So we're going to post our invoice. Now, while this is posting, we'll talk a little bit about what's going to happen. So during this posting, we're going to post to the deferred revenue account, and we're going to post to accounts receivable at this point. Being that it was a service item, we don't have a cost of goods sold or anything of that nature on this particular transaction. So when we look at our voucher, we'll see those particular pieces. So we're going to see our posting will be a debit to our accounts receivable account, so the 130-100 account. And then on the credit side, we posted the deferred revenue, so at 250-600, and that was for 250 as well. So this happened on 12/1. Now, when we go to our deferral schedule, and I'm going to go and navigate there from the deferrals window that we were in earlier. And I'm going to see that our deferral schedule number is here. I'll click on that link to take us back over there. And we're going to see our values, and we'll also see some information about the deferral. For instance, it's straight line, what was the customer account number, and then the accounts that are being used for the deferral, and where did it come from, what type of deferral is this. So it's a revenue deferral with a credit type, and it came from sales order 887. We can see right now we have $250 of unrecognized revenue from this particular schedule. And we can see our schedule blown out here. If we want to recognize that very first month of December, we want to do it on 12/31. We can do it directly from here. In a real life scenario, a user isn't going to come in here and click on each one of these. They're going to use the batch jobs that are available to do this, which will bring up a form similar to what you see here as the recognition processing. So we're going to create the revenue recognition journal here. In our cutoff date, we're going to use 12/31 of 2022. So our journal will come from our parameters, and then we can summarize this journal. In our case, we have one line here, but if you're, for instance, using the batch job, maybe you wanted to summarize all that information in that journal, you can do that. In our case, we're going to override the transaction date here because we do want that deferral to happen on 12/31. My system date right now is 12/1. That's why that was defaulted there. So we want that GL transaction to happen on 12/31. So in our scenario, we billed for the service item on the 1st of December, and then now recognize this particular revenue on 12/31. I'll click View Preview, and we'll be able to see the one line that we're going to recognize appear here. And then if we wanted to, we could take a look at the totals. With our scenario, we know we had the 1 month of revenue for 2083, so we can see that. Then I'll click Process. So what this is going to do is it's going to create the journal, and it's also going to post that journal. And then also, we'll see down in the schedule lines here, we'll see that now this first month of December is marked as recognized. It was recognized on 12/31, and it was recognized in journal 630. And then we can also see the voucher number here. So we'll go take a look at that voucher. So here's the journal. We'll click on the lines. We can see the lines here, but for a better view, we'll just go to the voucher here. And we'll see what happened here at 12/31 is we created a debit to the deferred revenue account, so 250,600. And this is going to offset what we had posted at the invoice time. So it's going to deduct that $20.83 out of that $250 that was originally posted to deferred revenue. And now we're posting it to our product sales or our revenue account, which is 401,100. So this all came from that deferral setup. We can see that information there. And in a later scenario here, we'll talk about how, for instance, maybe I had the wrong accounts in my deferral. If I needed to adjust those accounts or change those, we can modify that deferral schedule and see that particular information. Last thing I wanted to call out here is we can see the description. So in our case, we had the deferral schedule dates, so we can see that this came from deferral schedule 2. Then the dates covered were 12/1 to 12/31. You can also have the original transaction detail as the description, so you can toggle between those in the parameters as far as which information you'd like to see there. So that's our first scenario, service item, straight line deferral, and then we see the journal entries here as we saw posted to deferred revenue, and then at recognition time, we move from that deferred revenue to product sales.
All right, so that was our first example. Our next example, we're going to go and change things a little bit in this example because we're going to use a stock item. So in this case, we're going to add an additional layer to our deferral that we create. So in this case, a typical invoice voucher for a stock item is going to look something like this. So we'll have a debit to accounts receivable, a debit to cost of goods sold, a credit to our inventory account, and a credit to our sales. So this is no deferral, just a typical invoice posting. When we add the deferral to the picture, we have a little bit different posting happening here. So we're going to create two deferral schedules in this case, one for the revenue side and one for the cost side. So our original invoice voucher is going to change a little bit in that we're going to now post to deferred cost of goods sold, and we're going to post to deferred revenue. When that happens, what will happen is we'll break those out into two different schedules. So one on the cost side, one on the revenue side. So the revenue side will look like we just saw in the last example. When we do the recognition, then we'll debit deferred revenue and then credit our sales or revenue account. On the cost side, what we'll do is we'll then reverse our deferred cost of goods sold. So that'll be the credit, and then we'll debit our cost of goods sold at that point in time. So that's a little bit of the differences that we'll see in this next scenario, and we'll go ahead and take a look at that scenario now.
In our next scenario, we're going to look at the posting and deferral of a stocked item. In this case, we've got a sales order created here. If we look at this particular sales order, we're selling the item 1,000, and then this particular item is being sold at a cost or a price to the customer of $1,900. The interesting point to make here with this scenario is that now we'll end up with two deferral schedules at the end, one for the revenue side and one for the cost side. So we've got this all entered in, and we're going to invoice this as of December 1st. So we're going to go ahead and go to the invoice form here, and we're going to go ahead and invoice this. And at that invoice time, what's going to happen is we're going to hit that posting, and in GL, we're going to see our posting go to accounts receivable, deferred cost of goods sold, inventory, and deferred revenue. So if we look at our voucher here, we can confirm that. So here's our invoice voucher. So we see our deferred cost of goods sold, and then the inventory representing the cost side of the transaction. And then we have our deferred revenue and our accounts receivable. And now we'll have a deferral schedule for each of these, for the deferred COGS and the deferred revenue. We can see that by going to the deferral window here on the line. So here we have our deferral schedule number for the revenue side and the consumption side. If I click on the revenue side, we'll be able to see here that our recognition type is credit and our distribution type is revenue. And we'll see our deferral account is our deferred revenue, and then our recognition account will be our sales account. And we'll see that this is 12 months once again. So we use the same template that we used in the service item example. So we'll have $158.33, so that $1,900 over the 12 months of the schedule. If we go back, we'll see our cost side in the deferral schedule here under consumption. And here it's going to be $2.95 per month. And you'll see that this is recognition type of debit, distribution type is consumption. And then here we have our deferred cost of goods sold, and then our cost of goods sold as our accounts. Now, in this case, when we do the recognition, we can go ahead and we'll use the batch job because I'll try to grab both of those in one shot. So we can do that. We'll go to the subscription billing menu item, and then we'll go down to our revenue and expense deferrals, and we can go to recognition processing under periodic tasks. So we're going to create our recognition journal, and we're going to recognize this as of the end of December. So we're going to use December 31st. And once again, we'll override our transaction date so we can end up with the 31st of December here for the voucher. So in this case, we posted our revenue and our deferred revenue and our deferred COGS as of December 1st. And at the end of the month, we're recognizing these. And I'm just going to clean up the description here since we overrode the date. So we'll have that as 12/31. And if we view the preview, we'll see both schedules here for 13 and 14. And I'll just remove these two items because these are from a different schedule. And then we'll hit process. And that's going to go and create the journal and post it. If we go to our deferral schedules, so these were 13 and 14 if we recall correctly, we'll be able to see that that first month, so December, has been recognized, and we can go look at the voucher. So once again, on the revenue side, this is going to behave just like it did for the service item. We're going to see a journal here, and that journal is going to be moving our deferred revenue to our revenue account. So here we see that. So deferred revenue in our revenue account. And then on the cost side, we'll have a separate voucher. And that voucher here is moving our cost of goods sold or deferred cost of goods sold to cost of goods sold account. So we see that $295 move in this case. So that's the difference in a stocked item versus a non-stocked item. With the non-stock service item, what we see is we don't have the cost side of that transaction, so you don't get the second deferral schedule in that process.
All right. Our next scenario that we'll talk through is event-based deferrals. And this, we're going to do a service item again in this case, trying to kind of build off of our examples in each case, showing the different functionality depending on the types of items that we used. So in this case, similar to what we saw before, what we're going to do is at invoice time, we'll debit our accounts receivable account, we're going to credit our deferred revenue, and then at the time we have our recognition event, whatever point that is, we'll then see the deferred revenue and the sales get recognized. So we'll move out of deferred revenue and into our revenue account. So we'll jump into that example and take a look at that. I think there was a question that was in the chat that I saw about if the date changed. You'll see an example in this demonstration here about how you can add the dates or change those things using the modify schedule. So that would be how you can use that. So I'll take a quick look at this example here too.
In our next scenario, we're going to take a look at this billing schedule that we have here. And this is going to be for an item, which is installation services. And this is going to be 10 hours per month for a course of 3 months. So we have a setup here. So you'll see our start and end dates. And then we have our 10 hours, and this is going to be at $250 per hour. So we see all that information here. I'm going to take a look at the deferral here as well. So the difference in this scenario is we're going to be deferred, but in this case, we're not deferring it as a straight line. This case, we're going to be using an event-based template. So we have event-based, and I have a template for that event-based deferral scenario, which is an hours-based template. So we're going to do that based on a variable quantity. I've also expanded here the event template. Since we don't know when these particular hours are going to be completed, we don't have anything inserted here in the event template. We'll insert those as those services are performed and we meet those obligations. So we'll go through that example here. So first thing we'll do is we'll invoice for the month of December. So we'll run this out here and we'll create our invoice, and then we'll defer that revenue for the month of December. So we'll create our invoice, and then we'll go take a peek at our invoice and look at our voucher that comes from that particular invoice. So what we're concerned about here is just making sure that we defer that revenue. So we'll take a look at the invoice here and the voucher. So here we see we went to deferred revenue and we offset that with accounts receivable. So we debited accounts receivable, credited deferred revenue, just as we'd expect. Then we can take a look at our deferral. So as we go through that particular month, we might have hours that get performed and we want to record against those. So we'll go to our deferral schedule. So here we are, we see we have $2,500 that went into our deferred. We see we have no schedule lines. So if you recall back to the straight line example, we had, in that case, 12 months of schedule lines sitting here. As it comes time to record our hours, we can go to modify schedule here at the top left. And we see that same form that we saw in the deferral section earlier. And then we can insert our information. So maybe we want to enter our December hours. So we can put those in with 12/31 end date. And maybe in this case, we didn't complete all 10 hours in December. Some things came up, maybe we didn't necessarily meet that obligation. So we performed 8 of those hours in December. So we can click OK, and what's going to happen is we'll see it bring in our information here in our schedule lines. So we have 2,000 dollars, so that was based on the 250 and the 8 hours. So we'll still have 500 outstanding at the end of this particular deferral. So if we complete those hours in January, we can add a line and then recognize that revenue when we perform that service in January. So here we'll go ahead and recognize our December revenue. We'll put in our cutoff date of 12/31, and we're going to override the transaction date and post it as 12/31 as well. We'll create our journal. And we can go take a look at the voucher that was created and posted here. So here on 12/31, we removed $2,000 from deferred revenue and then posted $2,000 to our product sales or revenue account based on the recognition of those 8 hours of the services that we were performing. That's this scenario. We'll move on to our next scenario.
All right, I'm going to pass it over to Jodi, and we'll take a look at a couple of the unbilled revenue examples.
All right, thanks, Brian. So the first question is, why would we use unbilled revenue, or what is unbilled revenue? And if you need to recognize revenue that you haven't earned, or excuse me, that you have earned, but you can't bill the customer until sometime later, that's one reason that you could use the unbilled revenue feature. Or if the amount that you need to recognize is different than what's billed to the customer, like you're billing the customer straight line, but you want to recognize based on the quantity or consumed with the revenue earned, this is another reason or another way that you can use the unbilled revenue. And perhaps the most common is your general ledger does get updated with your unbilled revenue amount. So they appear in the financial reports and they can be tracked. So it's a lot easier to see what is been earned but hasn't been billed yet. You can keep track of that in your general ledger as you go through. So there's just a couple of setups for the unbilled revenue in subscription billing. So it's just the recurring contract billing, and then in the unbilled revenue setup, and you can do the items. So you can do table, group, or all for your items. And setting them up in the unbilled revenue page here, that just allows them to just default in as unbilled. So you don't have to go in and mark them all the time. So if they're always an unbilled revenue setup item or a group, you can set them up as a default. And then the accounts tab, which is the second screen that you see, this is where you can add your accounts in here. And if you're using the short term, you'll have those accounts available as well. And you'll see that there's an unbilled discount account that comes into play for the unbilled revenue too, that we'll see here in an example. But that's all the setup. And then in parameters for recurring contract billing, we do have separate parameters set for unbilled revenue. So the first one there is to post journal entry automatically. yes or no. Again, like Brian said before, if it goes over to the general ledger, do you want it to post automatically or not? There's the default journal name, which we've just set to general journal. And then here's that short-term unbilled method. So it's none, or rolling periods, or fixed year. And I do have an example of one of those that you'll see here. And then the next two options, they were added in 10.031, the auto renew. So you can require the journal entry for the renewal period, and you can auto create that journal entry for the renewal period. And it'll make maybe a little bit more sense once we get in, and I'll show you what the journal entry is. But if you want to have that unbilled amount every year for your unbilled revenue, you can require that. Or if it's only the first time that you want to do the billing, you only have to do it the once. So you don't have to require that, but that was added in 10.031. And then the last option there, the use unbilled offset accounts. These come into play typically if you're using multi-currency for your contracts, your billing schedules when you set them up. If you want to use these offset accounts, then it just makes sure that the unbilled revenue account is set up correctly and then reverses out with the same exchange rate as before. So that's just an option if you want to use that one as well. Okay, so a couple of examples that I have here. If you're doing unbilled revenue, so you've set up your billing schedule, you've marked the line as unbilled. The first thing that you actually need to do is what we call create the journal entry. So before you can generate any invoices, any sales orders, you have to do this create journal entry. And this is what posts over to the general ledger. So the unbilled revenue amount is going to be in your general ledger once this create journal entry is done. So it'll debit your unbilled revenue and credit your sales. And then once you do generate that invoice, then it goes to your accounts receivable and credits back out the unbilled revenue. So depending on how often you bill, if you're just billing once a year, if you're billing once a month, that unbilled revenue will get reversed out every time you do the billing. And if you're doing the unbilled revenue with deferred revenue, so you can do that or set both of those options on each of your billing schedule lines, then we have one step more where we do the create journal entry, which is the unbilled revenue and deferred revenue instead of your sales. And then once we generate the invoice, we do our accounts receivable and unbilled revenue again. And then once we recognize revenue, then it's the deferred revenue and sales. So depending on how you're set up, this is the different options that we have. All right, and then unbilled revenue and discounts. So when we do a discount on a billing schedule line, it automatically creates a general journal transaction for you with that discount account that we saw in the unbilled revenue setup. So it will post the discount and then the unbilled discount, which is very similar to that create journal entry that I mentioned, which is where we get the AR and the unbilled revenue. So it does do the general journal automatically when you're doing that discount as well, just to keep track of what's been billed and not billed for the unbilled discount as well as that revenue. And then when you generate that invoice, sorry, Ryan, when you generate that invoice, that's when we get the accounts receivable, the unbilled discount and unbilled revenue will both be reversed out then. Okay, so the first demo is just going to go through and talk about the unbilled revenue, deferred revenue, and then the discounts.
Okay, this video will talk about the unbilled revenue and how that is set up on a billing schedule. So first thing, I will go create my billing schedule. I'm going to click New, enter my customer account, and I'm going to start on December 1st and go for 12 months. Okay, now that I have my billing schedule created, I will add my line. I already have consulting set up for unbilled revenue. So when I click Save, my unbilled revenue checkbox automatically marks. Of course, I can go into the menu for unbilled revenue, and if I wanted to turn it off for this billing schedule, I can, or if I wanted to change the account numbers, I could do that as well. But everything is set up correctly, so I'll click OK. Okay, once we have billing schedules set up and our unbilled revenue marked, normally we would go in and generate our invoice. But at this point, we won't have anything to generate because there's one step we need to do before we generate the invoice when you have unbilled revenue. And that is under the unbilled revenue processing menu, we have to create the journal entry. This is the process that actually creates the journal entry that posts your unbilled revenue to the general ledger. I said that's one of the common reasons why people use unbilled revenue is to see it in your general ledger, and this is the transaction that will get it there. So if I click View Preview, you can see my total revenue is $1,200, which is the $100 per month, and I'll process. So it tells me that a journal entry has been created. Now I can see that journal entry on the billing schedule line. If I select Renewals, and you can see my journal entry batch is right here. I can select it, go into my lines, and you can see that it's doing the unbilled revenue, which is my non-invoiced account, and then hitting my sales for the credit. So that is how it's going to first hit my general ledger. So going back to my billing schedule, in the renewals, the other thing that you can see, there is an entry audit. So any changes that are done, it will keep track of those for you. For example, if my quantity should have been 2 instead of 1, I will get a message asking or telling me that changing the quantity, price, or amount, it'll reverse my original journal entry and recreate it with the new amount. And do I want to proceed? Yes, I do. I can enter a comment. We'll do the recalculation date as of today. And my journal name, again, defaults from our parameters. So I'll click OK, and it tells me that a journal entry was created, reversing journal entry was created, and then a new one. So if I click on the Unbilled Revenue Journal Entry Audit, it'll show me the history of what it's been done. So there's my initial journal entry, the reversal, and now my new journal entry as well for the 2,400 instead of 1,200. So again, now my general ledger is still updated. It's still set to the unbilled revenue that I have. So another option that we looked at is the discount. So the discount, when I add that discount to my billing schedule, I'll mark the box for the discount. I'll have it start on December 1st. And we'll say it's a 5% discount. It'll go for the entire billing schedule, so I don't really need the end date. So once I click OK here, it automatically creates yet another journal entry for me. So if I go back into escalation and discount, that journal batch is going to be here as well. And if I select that, again, in my general journals, in my lines, you can see it does post to my discount account as well. So there's an unbilled discount that it's keeping track of again in the general journal. So everything is correct in my journal so far and on my billing schedule. You can see I have my $2,400 for my billing schedule. And now let's say we're ready to bill that first month. So now I can go to generate invoice. I have my billing schedule. I can do view billing schedules. And I'm just going to bill the month of December. That's fine. So I'm going to click generate. And now it's generated that one line for me. So I can go to view billing detail to see my invoice, since I did post my invoice automatically. And once I drill into my invoice and select my voucher, you can see that it's reversing out my unbilled revenue, my unbilled discount, and then it's posting to my accounts receivable account as well.
Okay, so the next one is short-term. So with unbilled revenue, you can use what they call the short-term method, and there's two different methods that we can use. One is rolling periods, which is this example here, and the other one is fixed year. So rolling periods basically means it's for the next year. So 1 year from today minus 1 day is basically your rolling period. And what happens with that? So your billing schedule in my example here is 19 months. So we start in June of this year and go through December of 2023. It's $100 per month. When I do my create journal entry with the short-term method here, I get my standard unbilled revenue and sales, but I also get the short-term adjustment entry as well in that same journal entry. So it does all of that at the same time. And what it's doing is putting that $1,200 for my short term, which is the next year. So it's putting that $1,200 in my short term. So my short term unbilled revenue amount would be $1,200, and then the long term at this point would be $700 because I haven't billed anything. If I go generate the invoice as of November, it does the standard accounts receivable and unbilled revenue, and that doesn't do anything else because I'm still in that rolling period window. So my short term is still $1,200. My long term now is just reduced to $100 because I'm still in that 1 year. So if you go to the next one, Brian, to contrast that with the fixed year, this is a little bit different because the fixed year is just to the end of this fiscal year. So in our sample data, it's just to the end of December. We're on January to December calendar year for our fiscal year, but it just looks at the end of the fiscal year. So you can see that that first create journal entry that we do at fixed year, it does 700 for my short term instead of the 1200, which is what the rolling periods did. So in this case, then I have 700 in my short term and 1200 in my long term. We'll see this once we get into the demo. I show that as well. And then when I generate the invoice, I do the standard 700 because this one I'm going through the end of December. And then for the generate invoice for the general journal transaction for that short-term adjustment, it does 500 because it's taking the rest of that long-term and putting it into short-term. So since I'm down to the end of that fiscal year, I don't have anything else in long-term. Starting with January of the next year, then I have the 1200 in my short-term again. All right, and then one more example that we have here is unbilled revenue and deferral, but using the profit and loss deferral posting method. So Brian showed this on the parameters page where you can set this to balance sheet or profit and loss. Balance sheet is what we've probably been talking about and showing, but we also have another one called profit and loss. And with profit and loss, that gives you extra postings. So like when you do your create journal entry, which again, we do that with our unbilled revenue. So we do the unbilled revenue and deferred revenue. And then we have these recognition offset and then initial recognition account. And these are the profit and loss accounts. So these are hit when we do that create journal entry for the same amount here. And then this allows you to see the differences between your deferred revenue and your revenue when you're going through and looking at your posting accounts. Because revenue is recognized monthly, it can make it harder to view what your actual revenue is per month. So using the profit and loss method, if you have that recognition offset, it can help you just look at those balances better. So it's more of a reporting thing as to why you would want to do it this way. It's just an option as far as how you want to do that. But those are the different distributions that we have for the profit and loss method. And now we'll see a demo.
In this first example, we're going to walk through the unbilled revenue with the short-term method of fixed year. I have my billing schedule set up for 19 months, so June of 2022 to December of 2023 for $100 a month. I've also marked this as unbilled revenue, and I do have my parameter set to fixed year. Now this fixed year means that when we bill, it's going to do some short-term adjustments for the end of the fiscal year, which is the fixed year option that we're using. So let's create the journal entry since we're doing unbilled. And we'll just put this back in June since that's when we could have done that. And I'll process this. Now, once that create journal entry is done, it's updated here in the renewals on the line details. And I'm going to go to my batch because this is where we'll see the postings. So the general journal, as normal, it does my unbilled revenue and my sales, and then it also does these short-term adjustments. And it does the $700 because we have the 7 months left of this fiscal year. The best way to see that is actually back on this renewals tab. You can see that there's the current short-term and the current long-term amount set here. Now, since this is a 19-month billing schedule, the short-term is the rest of this fiscal year. So again, I started in June, it would go through December. So the short term is 700, long term would be the rest of the next year because I haven't generated any invoices. So let's go ahead and generate the invoice now as of December of this year. And we'll post that automatically. So once it goes through and generates the invoice, I can go into view billing detail. And there's a couple of things that we can look at. The invoice itself is just our standard accounts receivable and unbilled revenue, which we've already seen. But we do see this unbilled journal entry that it also created. So if I go into the unbilled journal entry again, it's a general journal. And this is where it does another adjustment for the short term because we billed now as of the end of December. So it does that extra $500. And the reason that it does that is because if we look back on our renewals tab, so back out on the billing schedule, our current short term is now 1,200 and the current long term is 0. Since we've billed through the end of this year, that current short term is back up to 1,200 because we're using that fixed year. So as of the 1st of January for the next year, which is what our next billing would be, we have that short-term method with the short-term amount of 1,200, long-term is 0. So it's just easiest to see it right here. You can also get that printed on different reports as well. So that's just an example of using the fixed year for the short term. Okay, we will close this billing schedule and go out to my recurring contract billing parameters. This is where that short-term unbilled method is set. I'm going to change it to none because the next example that I want to show you is actually unbilled revenue and deferrals, but using the profit and loss deferral posting method. We've been looking at the balance sheet method, but we're going to go through the profit and loss one. And that is set up in the revenue and expense parameters. So I'll just quickly show you that one. So we're going to be using the profit and loss for this one. Okay, so let's go to billing schedules. And I'm going to create a new one. For Cape wholesales, and I'll start this one in July of this year and go for just 12 months and end it in June. And I'm going to use a stocked item this time. And we'll change that pricing method to flat, just so I can make it an even amount of 500. And I do want to set this as unbilled, so I can just come in and do this. I could default this in as well, just like we've done before. And I'm going to set this as deferred. Now, since I have a stocked item, we have both the revenue and the expense or the cost side for the deferrals, and it will create both for us. And I'm going to use a template for that, just 12 months. Okay, so we will do the create journal entry since, again, we're doing unbilled. And I'm going to set that back to July. I'll go ahead and process that one. Now, what's going to be different about the journal entry for this one, again, if we scroll down and go into renewals, if I open up that batch again, so we have our standard unbilled revenue and then deferred revenue since we are doing the deferrals, but we also have the profit and loss accounts. These two accounts are used to better keep track of your revenue and your deferred revenue because you have the revenue and the deferred revenue and the in and out of recognizing that revenue every month. It's a better way to keep track of what your true revenue is per month and not just lumping it all together in deferred revenue. So this is just a better way to keep track of that. If you run your reports for your revenue and your revenue offset, you'll be able to see that information. So that's why that's one reason that we can use this profit and loss account. But that's where you'll see it is the create journal entry for this one. Okay, since we are using unbilled revenue and deferred revenue at the same time, my deferral schedule for revenue was already created. You can see that right here again on the renewals tab. And now I'm going to generate the invoice for that first month. So I'm going to change this back to July. And do view billing schedules and bill that first month. Okay, and now that we've done that, if I go to view billing detail, I can check the deferral tab, and this is my consumption or my cost deferral. So if I click on this, you can see that that's been created as well. Now from here, it's just recognizing the recognizing the deferred revenue and the deferred cost on the recognition schedules, which we've already seen. So those are going to be the same from here on out. And that is the example for unbilled revenue and deferral using the profit and loss method.
All right, our next example, we'll take a look at multiple element revenue allocation. So this is that third module when we talk about the different modules. So why would I use this? When does this come into play? So typically you use this if you have a discounting scenario or where you're selling multiple items together, right? So you might discount it somewhat or fully discount a particular item in that grouping. So this is typically a compliance item, whether it's IFRS 15 or ASC 606. So what happens in this case is you need to be marking the items for deferred, right? Because they need to be deferred items. But then we're going to allocate the price or the cost of that item that is discounted across to figure out what should get allocated for revenue across all those items. So we'll take a look at that particular example of Mira.
Our next scenario, we'll take a look at multiple element revenue allocation. So in this scenario, I have a sales order, and this could also be done from a billing schedule. And on my sales order, I have two lines. I have a Surface Pro, which we're charging at the normal price, so it'll be $1,900. But you'll see on this installation services line here, so our second line, we actually gave the customer a price break. So we're actually throwing that in for free. So we need to allocate revenue from the $1,900 of the Surface sale to this installation services line. In this case, we have both of the lines marked as deferred. So I'll just pull those up real quick so we can see that they're marked as deferred. So we see they're both marked as deferred. Now what I need to do is I need to look at my revenue allocation. So I'll go to the invoice tab, and I'm going to click on revenue allocation at the top. Now in this case, we want to do a single multiple element arrangement. So I set up an MEA template, so multiple element arrangement. So I have this agreement here. And then what I'm going to do is I'm going to allocate that revenue out based on the standalone sales price. So $1,900 for the Surface item and $200 for the installation item. So what that's going to do is it's going to allocate $1,719.05 to the Surface and $180.95 to the installation. So this is as we want it. We can click Save here and close this form. And what will happen now is when we go and invoice our order, we'll create the deferral schedule for both items with that revenue allocated out. Without that MEA template involved, what would happen is we would get a value of 0 for the installation services, and then all the revenue, the $1,900, would have been allocated to the Surface item. And that's not what we want. We want that to be spread across both items on this particular order. So our sales order is just finished posting here. We'll go take a look at our deferral schedules that were created. So we'll go to subscription billing and we'll go look at our all deferral schedules. And we'll see down at the bottom, we'll have a deferral schedule for this particular sales order. So we have 3 lines that came from that sales order. One's the cost side, and then 2 of them are the revenue side. So we'll take a look at Schedule 31 and Schedule 33. So Schedule 31 is for the Surface item, and this is where we'll see that $1,719.05 that gets allocated based on that MEA template, and then our monthly allocation of that. And if we look at 33, that'll be for our services item, our installation item. So we'll pull that one up here, and that's for the $180.95. And that gets recognized also based on that template that we had. So that'll be $15.08 per period for 12 months. That's the end of the example on Mira. Thank you.
All right, we covered a lot of content today. I see we had a pretty active Q&A. Adeel, I just wanted to ask you real quick, did you see anything in the questions and such that we should maybe bring up here and make sure that we talk through?
Yeah, Brian, thank you. And this was a very intensive Q&A ongoing. So we saw a lot of questions coming in about the projects, integrations with project operations, or our support for non-stock and stock cases. So maybe a bit of word on that.
Sure. So in our roadmap and our release plans that you'll see published for the current wave, which would be essentially our April release, we're working on project integration for the project management and accounting side of things. So think of project within finance and operations. So that's what's on the docket for the current wave. As we move into the next wave, then you'll see us move into some other scenarios as well.
All right, and we have a lot of questions that came in, specific to different business processes, export related, or where different business how do they actually do the deferral. So maybe I pick one which we haven't answered yet, that just came in from Stuart. Can you do revenue allocation against an item that is billed as a one-time service item? For example, the customer has subscribed to a monthly subscription. In the first month, you want to allocate revenue to another service item that you provide as free for the first month.
Yeah, so in that scenario, if I read the question correctly here, so we want to take the revenue and spread it across two items, but only for that first month. So in that case, what you'd have, for instance, if I was coming from a billing schedule, so you'd have the recurring item, and then that service item would be a one-time frequency in that case. So you can defer that one-time item as well as defer the original item, and then you could use a Mira template for that scenario where you have both of those on that billing schedule, and then it will allocate that revenue across for that first month. And then after that one-time frequency is up for that first month of the service item, then you'd have recurring billings for the original subscription item, which would then be deferred based on the price for that item each month.
All right, just one more that came in for project integration. Is there a preview planned, Brian, before the launch in March? Are we offering some sort of preview for this one?
So we still have the early access or the preview options that were available throughout in our prior releases. So in the past, we had something that was called the PEEP program, or Private Early Access Preview. The entrance to that particular program, and that program has been kind of discontinued, if you will, but everyone has access to those preview builds now. So you can get those preview builds. They're available. You can put them on sandbox or dev machines, but you can't take them to production machines. So I believe.
So basically, the 10.0.32 public preview should have the preview release should have the functionality.
Correct. One caveat to that I'll bring up. In one of the earlier slides, you saw where I showed the features that we have in feature management. For when that 10.0.32 release goes out, there's an additional feature in there for the project management and accounting integration. So if people take that preview and you're not seeing the functionality in there, you'll need to make sure that you have that particular feature enabled.
Yeah, I think we are almost at the top of the hour, but maybe the last one is it's a good one. Does the Mira handle partial billing versus ASC 606 allocation better than the old RevRec engine? So I guess on that one, yeah, Brian.
It's a good question.
Yeah.
I would have to take a look at it just to be sure. I can do that and then potentially follow up. The question was submitted by Anonymous. If you want to just put your information in a new question and send it in the chat, or if you want to send that same question through the email address you see on the screen here, we can route it to me and I can take a look at that scenario and validate that it does work correctly.
If you know that there was a gap already with the old RevRec engine, we would certainly be interested in filling that gap, right? If you haven't done so, yeah. All right, I think Sujita and Jodi, they did a great job in answering a lot of those questions. It was a non-stop Q&A ongoing. So I guess over to you, Tim.
Thank you, Adeel. I've posted a link to a short survey in the Q&A panel. We'd love to hear feedback on today's session and hear what you'd like to see in future events. Thank you for your participation. As a reminder, the recording of today's session will be made available on the Tech Talks Community Dynamics page within the coming weeks. I'd like to extend a big thank you to our presenters today and to you, our audience, for joining us. We hope you have a great rest of the day ahead.